Welcome back to The Explainer. Today we're doing something incredibly exciting. We are taking a powerhouse stock, EMCOR Group, ticker EME, and throwing it right into the ultimate valuation gauntlet. We're not just going to look at a chart and guess here. We are going to apply the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll cross-reference those with modern discounted cash flow and multiple-based models. By the end of this, you're going to know exactly how the greatest minds in finance would view this company today.
Here's our quick roadmap for today. Number 1, an EMCOR snapshot. 2, the Buffett lens. 3, the Lynch lens. 4, the Graham lens. 5, DCF and multiples valuation. And finally, 6, our synthesis and verdict.
Section 1, EMCOR Group Company Snapshot.
Okay, before we crunch the numbers, let's ground ourselves in what EMCOR actually does. They are an absolute titan in electrical and mechanical construction, plus industrial and energy infrastructure. Basically, think of them as the people who actually build the complex physical backbone of our modern economy. They're out there designing, implementing, and maintaining mission-critical systems for high-growth sectors. We're talking data centers, high-tech manufacturing, healthcare. When the world needs massive energy efficiency retrofits or central energy plants built on a truly industrial scale, EMCOR is usually the operator getting the call. And man, the market has certainly reacted to that level of expertise. The stock currently sits at a towering $797.43. That gives EMCOR a massive market capitalization of just over $35 billion. And it's not just hype. It's fueled by some really phenomenal fundamentals. In Q2 of 2026, they posted record revenues of $5.15 billion. That is a nearly 20% increase year over year, alongside a record-breaking operating margin of 10.6%. Section 2, the Warren Buffett lens. So let's look at this through our first guru. EMCOR passes Buffett's quality check with absolute flying colors. We all know Buffett loves capital efficiency, right? Well, EMCOR boasts a massive 37.12% return on equity alongside a return on invested capital nearing 40%. That points to a highly entrenched economic moat, likely driven by their sheer scale, their specialized workforce, and their ability to execute really complex projects. On top of that, they have a deeply manageable debt-to-equity ratio of just 0.11. In fact, S&P Global recently noted they operate with a zero net debt position. That is exactly the kind of bulletproof balance sheet Buffett goes looking for. But what about the value? Buffett focuses heavily on owner earnings. For the first half of 2026, EMCOR pulled in over $709 million in net income. Now, we are making an assumption here that their free cash flow conversion remains robust based on historical construction norms, but Buffett would definitely admire the cash-generating power of this business. However, to actually pull the trigger and buy, Buffett demands a true margin of safety. Usually, he wants a 25 to 30% discount to intrinsic value. Given the stock's massive recent run-up, he'd likely categorize this as a wonderful company, for sure, but he'd demand a significant price drop before deploying capital. Section 3. The Peter Lynch lens. Now for Peter Lynch. Lynch famously categorizes stocks into very specific buckets. For a company of this size, you might automatically assume they're a slow-moving stalwart, but you'd be wrong. Based on their Q2 2026 results, diluted earnings per share jumped an incredible 34.8% year over year, going from $6.72 to $9.06. Driven by a frankly eye-popping $17.1 billion in their backlog or remaining performance obligations, Lynch would undoubtedly categorize EMCOR as a fast grower. But the real magic here happens when we look at the PEG ratio. Lynch popularized the price-to-earnings-to-growth ratio to see if a stock's growth actually justifies its price tag. So if we take EMCOR's trailing PE of roughly 26.8 and divide it by that massive 34.8% EPS growth rate, we get a PEG ratio of 0.77. In Lynch's framework, anything under 1.0 is considered undervalued. So combined with their flawless balance sheet and strong institutional respect, this metric flashes a massive Lynch-style buy signal. Section 4. The Benjamin Graham lens. Next up is the strictest test of them all. Graham's defensive investor checklist is notoriously hard to pass. Now, EMCOR easily clears the hurdles for adequate size, earnings stability, and an uninterrupted dividend record. It also passes the financial condition check, with a current ratio of 1.28, which is well above his threshold. But it absolutely fails Graham's valuation tests. Graham wanted to see a price-to-book ratio below 1.5. EMCOR is currently trading at nearly 9 times our derived book value of roughly $90 a share. So the crucial point is applying his famous intrinsic value formula, just to see exactly where Graham would price this thing. The formula is the square root of 22.5 multiplied by the trailing EPS multiplied by the book value per share. If we input the trailing EPS of $29.66 and that estimated $90 book value per share, we get a pretty fascinating result. The math outputs a strict Graham intrinsic value of exactly $245.07. With the stock trading up near $800, yeah, Benjamin Graham might just roll over in his grave looking at that premium. There is literally zero margin of safety here for a traditional deep value investor. Graham would look at the immense premium being paid over the tangible assets of the business, and he'd just walk away. A strict Graham disciple wouldn't touch the stock at its current heights.
Section 5. DCF valuation and other models.
Moving into more modern Wall Street techniques, because explicit long-term future cash flow projections aren't provided in the standard earnings release, we have to make some informed assumptions to build out our base case DCF. I'm explicitly assuming a 9% weighted average cost of capital here. That reflects the current interest rate environment, and there's zero debt structure. For the terminal growth rate, I'm using a conservative 2.5%, which aligns really nicely with standard construction industry averages and long-term GDP growth.
Flexing those assumptions reveals a super compelling picture. This sensitivity table shifts our WACC between 8 and 10% and our terminal growth between 2 and 3%. Under these modern baseline metrics, assuming continued strong execution on that massive $17 billion backlog, EMCOR's fair value sits comfortably in the $800 to $850 range. So from a pure future cash-generating perspective, this model actually suggests the current market price is entirely justified.
And we can cross-reference that DCF with comparable multiples just to be sure. Management recently raised their 2026 EPS guidance to a midpoint of about $32.62. If we apply a reasonably conservative 30 times forward PE multiple for a high-quality industrial compounder, that gives us a fair value near $889. Similarly, an enterprise value to EBITDA approach, leveraging their expanded 11.2% adjusted margins and zero net debt, yields a bullish target well into the 800s too.
Section 6. Synthesis and final recommendation.
Bringing all these different frameworks together reveals a really stark, fascinating contrast. Benjamin Graham's strict asset-based approach is screaming sell with a $245 valuation, but Peter Lynch's growth the price framework is screaming buy. Meanwhile, Buffett's quality metrics and our modern DCF and multiples models suggest the stock is actually fairly valued right now, sitting comfortably in that $800 to $889 range.
So what is the final recommendation here? Blending these insights, EMCOR earns a very solid hold at the current price. The key strengths are just undeniable: massive macro tailwinds from data centers and high-tech manufacturing, a jaw-dropping $17 billion backlog, and a pristine zero-debt balance sheet. However, the risks are heavily tied to valuation and execution. S&P Global recently noted a shift toward guaranteed maximum price contracts. If there are cost overruns on these massive, complex projects, those margins could shrink rapidly, and a stock that is priced for perfection could face a pretty harsh correction.
Ultimately, you are paying a premium for a best-in-class operator. They aren't just selling software. They are literally out there building the physical infrastructure of the next technological revolution. It's a phenomenal business, but as Buffett reminds us, even a wonderful business can be a bad investment if you pay too high a price. So I want to leave you with this final thought. You've seen the gauntlet, you've seen how Lynch loves the growth, how Graham absolutely hates the premium, and how the DCF actually justifies the present. At what specific price does EMCR trigger a buy for your personal margin of safety? Take these legendary frameworks, apply them to your own portfolio decisions, and keep learning. Thanks so much for joining me on this explainer. See you next time.